Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today, we're looking at critical metals core.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis. And this one is particularly interesting because the company's recent history is really split. You're looking at two completely different financial narratives.
Right.
So to understand where critical metals core is today, you really have to appreciate this massive contradiction from the beginning of 2025.
And that contradiction is what makes the story so compelling, isn't it? I mean, if you rewind to those really bullish reports from early 2025, the company looked like a powerhouse.
A total cash-generating machine.
Exactly. Those snapshots showed Q1 2025 revenue hitting, what, $26.4 million?
$26.4 million, which is a 54% jump year over year.
An eye-watering jump. It blew away all the expectations.
And the margin story that went with it was, well, frankly, it was phenomenal. Those sources claimed the gross margin expanded to 44.2%.
Wow. And for our listeners, that kind of expansion, that's a 1,210 basis point improvement.
It's massive. Over 12 full percentage points of extra profit on every single dollar.
And it wasn't just random sales. The alignment was perfect. The reports claimed 61% of sales were going to their defense and aerospace REE division.
Which positioned them perfectly, with the U.S. defense rebalancing and all the focus on securing supply chains.
Crucially, too, that story presented a company that was already flush with cash.
Oh, absolutely. It claimed they generated $16.3 million in positive free cash flow.
In a single quarter.
In one quarter. That's cash left over after everything.
Yeah. And
they supposedly had a net cash position of almost $48 million.
So it sounds like a mature, profitable specialty metals company.
It does, but...
Yeah.
And this is the huge but.
Here's the gut punch.
Exactly. This is the tale of two companies. Other information from that exact same time, early 2025, it painted a picture of a completely different entity.
Not an operational powerhouse at all.
Not even close.
Yeah.
This other narrative described them as basically an exploration vehicle.
Okay.
A company trading on, over-the-counter markets.
All right.
Characterized by minimal revenue.
And when you say minimal, you're not kidding.
We're talking quarterly figures, closer to $28,000.
Not $26 million.
Not $26 million. And that report showed ongoing net losses around $1.87 million and basically struggling to keep any cash on hand.
The disparity is just, it's huge. It makes the current financial so important for figuring out what's real.
It's the only way to bridge that credibility gap.
Okay, so let's set aside those conflicting histories and focus on what we know now.
Yeah.
The latest reality from November 2025.
Right.
The numbers seem to show they are moving toward being operational, but they're nowhere near that $26 million dream yet.
Not yet. But the growth is there. The current filings show accelerated top-line growth, which does validate that operational shift. Revenue for the full 2025 year was up an incredible 376.5%.
Okay, that is undeniable momentum.
It is. But the high growth rate only brought them to a total revenue of $560,623.
Such a striking contrast. So they are growing fast year over year, but the actual dollar amount is still tiny compared to the valuation and those strategic claims.
That's the puzzle.
So how are they managing costs during this big expansion and still keeping all these big institutions interested?
And that's really the core of the whole investment thesis right now. On the cost side, they've actually been pretty efficient. Net losses were cut by 62.8%.
So they're getting better at what they do.
They're getting more efficient. Now, the net loss is still huge, over $51 million. But cutting the rate of loss, that sharply shows they're making progress.
Right, but it's still a loss. And you mentioned free cash flow earlier. If they're in heavy development mode, that's got to be negative, right? They're burning cash.
Oh, for sure. FCF is still negative. That's expected. They're pouring money into capital expenditures, developing mines, building out facilities. All of that has to happen before the big revenue comes in.
So where does that leave their financial stability?
Well, the good news is they have low leverage. Their debt-to-equity ratio is only 0.16.
And that low debt gives them flexibility, which is so important for a company at this stage.
It's critical.
But the second you look at liquidity, that's where the alarm bells go off for me.
They do.
Their ability to meet immediate bills is, well, it looks weak. The current and quick ratios are both at 0.13.
which is concerning.
Mm.
For anyone listening, a ratio under 1.0 is a red flag.
0.13 is a huge red flag. It suggests they are under serious cash pressure.
That number is probably the single most important thing to watch if you're thinking short term. It means they have 13 cents of liquid assets for every dollar of short-term debt.
And that weakness connects directly to their recent financing, right?
It has to. To deal with that exact problem, they secured a private investment in public equity, a PIPE financing, back in September.
A PIPE, so for clarity, that's selling shares directly to a big, sophisticated investor, usually at a discount, to get cash in the door quickly.
Precisely. This is them shoring up the balance sheet.
Yeah.
They issued over 3 million shares and warrants to get that cash infusion.
So they can keep the lights on and hit their long-term goals.
Exactly. The market seems to see it as a necessary evil to survive this scale-up phase.
Okay, so let's shift to the why. Why is all this smart money so convinced? Why are they pouring in millions via a PIPE when they see a $51 million loss and a 0.13 liquidity ratio?
Right.
Where's the moat?
The moat is almost purely geopolitical
Yeah.
and resource-based. They are, one of the very few publicly traded companies specifically targeting European and Greenland assets for lithium and rare earths.
So it's not just a mining play,
No, it's a sovereign supply chain play.
meaning they're set to benefit from political necessity. The EU, especially, is desperate to get out from under its reliance on China for these critical minerals.
That's their competitive advantage, the political tailwind. And this brings us back to that very aggressive defense alignment thesis we talked about earlier.
The Department of Energy grant.
The $28 million grant from the DOE under the Defense Production Act.
And getting DPA funding basically means the U.S. government sees your output as essential for national security.
It does. Demand for those high-purity rare earth oxides, the stuff that goes into military hardware from contractors like Northrop Grumman, that demand is non-negotiable.
That creates a huge barrier to entry for any competitor.
And this is the why. This is the reason institutional ownership is the metric to watch here. It's sitting at an extremely high 86.4%.
86%.
Sophisticated investors are piling in based on that long-term resource base and that strategic positioning. They're valuing future political relevance way more than current profitability metrics.
So the market is valuing them as a hedge against a supply chain crisis. You're investing in necessity, not cash flow.
At this stage, yes.
Okay, so let's look at the technicals. What does the chart action say? Does it back up this thesis?
The chart suggests that, yes, persistent buying is happening. The stock's in a very strong short-term bullish trend.
Higher lows and higher highs.
The textbook definition of momentum.
What about the moving averages? I know a lot of people watch those for confirmation.
And they're getting it. The 50-day moving average is solidly above the 200-day moving average.
The golden cross.
The golden cross. For technical traders, that's a powerful signal that the intermediate-term trend has broken out to the upside. It suggests a sustained move higher could be underway.
And the analyst price targets seem just as aggressive.
Oh, they are. Some are seriously ambitious. They're projecting a trading range with resistance all the way up near $47.59.
$47.
The whole range for December is pretty wide, from about 34 up to that 47 mark. These targets are baking in a lot of future success.
Now, we know institutions like Vanguard and Fidelity were accumulating earlier in the year, but there's always a countersignal. We have to talk about the insider selling.
Yes, that's a really crucial piece of the puzzle. Right after that PIPE financing closed in September, we started seeing Form 144 filings pop up in October.
And that's insiders getting ready to sell shares.
It's an intent to sell, yes. A legal notice.
So how should you interpret that? Is it a red flag? Insiders getting out while they can?
It requires some nuance. Often it's just a liquidity event for early investors or execs. The stock gets unlocked, they need cash.
Right, they've been holding illiquid paper for years.
Exactly. So it's not always a vote of no confidence.
Yeah.
But the market usually sees it as a negative because it looks like the people who know the most are taking profits just as new investors are coming in.
Okay, understood. So the technicals are bullish, but there's this mix of institutional buying and insider selling. It all points to a ton of volatility around upcoming events.
Intense volatility.
So what are the key confirmed catalysts we should be marking on the calendar?
The single most important one is the Q3 earnings release. That's expected around November 25th. That report could either validate this whole high growth narrative or, completely derail it.
And right after that, there are external market forces that could move the stock, correct?
Yes. Keep an eye on the ETF index rebalancing on December 2nd. If they get added to a major materials or clean energy index, that forces passive funds to buy millions of shares.
And then the 13F filings?
Right. Around December 15th, we'll get those institutional buy-in disclosures, and we'll see exactly which big funds were buying during this last quarter.
And then looking into next year.
Q4 earnings guidance in January 2026. That's the first official look at their plans for the new fiscal year.
Okay, so those are the confirmed dates. What about the rumors? The market chatter that drives a lot of the retail interest.
The biggest rumor is about their flagship asset, the Greenland Tambreez mine.
What about it?
Chatter about an accelerated development timeline. If they could pull that forward significantly, it would completely change the long-term valuation picture overnight.
Accelerating a major deposit like that would be huge. And what about partnerships?
That's the other big one, persistent talk of a strategic joint venture.
With who?
The rumors point to either a major global metals firm, which brings capital and expertise, or maybe even an EV OEM.
An electric vehicle company trying to lock up their own supply chain.
Exactly, cutting out the middleman, guaranteeing demand for themselves.
A deal like that would totally change the risk profile. They'd go from being a high-risk developer to a preferred supplier in an instant.
Ultimately, the story of Critical Metals Core is a study in conviction. You have these huge losses and, frankly, scary liquidity metrics, but you have extreme institutional commitment, almost 90% ownership, and this incredible strategic positioning.
In geopolitical hotspots.
Exactly, in Europe and Greenland. It suggests the market is valuing that potential, that sovereign supply chain relevance, way more than it's valuing current profits. That November earnings report is going to have the moment of truth. It's critical for validating this growth story and seeing if there's a real path to those big price targets.
It is a really polarized investment case. You are absolutely betting on politics and necessity over today's cash flow. Make sure you subscribe to Smart Wealth with Joshua so you don't miss our follow-up analysis immediately after those Q3 numbers drop.